Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Chuck Fuller, Portfolio Manager at Nasdaq Dorsey Wright. He joins us to discuss asset class and sector rankings as U.S. equities retain the top spot after an explosive move off the October bottom. It is great to see you as always, Chuck. Welcome back to Trade Talks. And certainly this is a very different conversation that we're having now versus the beginning of Q4. I mean, the move has been quite remarkable.
It really has. I mean, so we bottomed, towards the latter part of October, and I think we had talked about last time I was on that some of our indicators were fairly washed out, so we were due for a bounce. I didn't expect it to be this explosive, but yeah, I'll take it. It's been quite the move. We briefly, if we look at our asset class rankings, we kind of briefly had U.S. equities fall out of the top spot. But it quickly came back actually here in probably the last week or so. Has made it back to the number one spot and has really taken the baton and kept moving. It seems like every day when we update these rankings, the gap between U.S. at number one and international and commodities at number two and number three just continues to widen. So that's a good sign for U.S. equities. And looking at some of these indicators that I talked about before that were kind of washed out, last time we talked, they're kind of on the other side of the spectrum now, where they're starting to get a fairly overbought. I think one thing that's interesting about that though is you have to keep in mind that when certain things like this, and specifically I'm talking about something like the percentage of stocks in the S&P 500 that are above their 50-day moving average. When you see that up at high levels, most people, instinctively think that, okay, well, that's bad. It's only got one direction to go. It's got to go back down. But in reality, what we find is that when things get really overdone to the upside, that's actually also bullish. Whenever you see this particular indicator, hit the levels that we're seeing now, it's more often than not really good over the next year or so. And you're usually up, well beyond what the market typically gives you in a given year. So we're pretty optimistic, and looking at what's happening today, you've had the Nasdaq 100 hit its all-time high, first time in, about 2 years since we've seen that happen. All told, it seems like everything's kind of pointing in the bullish direction.
Mm-hmm. Well, let's take a look at sectors for a moment here, because of course, one of the narratives for 2023 was the concentration that we saw, particularly with the Magnificent Seven in the tech space. Does technology still remain at the top? And what are some of the other movements that you've noticed among the sector rankings?
Yeah. Sectors, really technology all through this decline and then obviously subsequent rally that we've had, technology remained at number one. And it just appears to be getting stronger. So yeah, we don't see any signs of that stopping anytime soon. Looking at some of the other sectors, we have industrials are at number two, that they've been high most of the year. We have seen energy fall from number three to number four, which kind of makes sense. Oil's been pulling back quite a bit here recently. It was replaced by consumer cyclicals at the number three spot. And probably the biggest move I would say we've seen over the last month or two has been in financials, right? Financials have had a lot of problems this year, specifically back in March with some of the like Signature Bank and Silicon Valley Bank having issues that they had. That really kind of depressed financials for a while, and we've seen them just in the last month move from number 8 up to number 5. So that'll be an interesting thing to watch.
Where do international equities and fixed income fall in the spectrum?
Yeah, so I mean, internationals at number 2. Like I said before, U.S. equities have kind of widened the gap between them now. Partially that's going to be because international has kind of lagged the U.S. equities off the bottom, but it's still at number 2, still definitely an investable asset class, we would say. And the rankings there have been stable. We haven't seen a lot of changes. So emerging Europe has been number 1 basically the whole year, and Latin America is at number 2. It's been around that spot the most of the year. So yeah, everything there is about where we left it a month or two ago. And in the fixed income space, obviously we've seen a lot of changes there with the Fed kind of seeming to have a dovish pivot here recently. The 10-year yield is obviously, returned back to earth, is up, around 5%. Now it's, a little bit below 4%. That's for the first time since July. But looking at our, rankings underneath the hood of fixed income, we still find high yield at number one, where it's been most of the year. We've seen short duration treasuries have fallen a bit, as, kind of makes sense, given the bullish move we've had. And we've seen, U.S. corporates jump from number 6 to number 2. Probably the one thing that might surprise some people is that long duration treasuries are still kind of at the bottom, even though they have, been going up like crazy here in the last, month or two. A lot of that comes from just the really bad performance that it had in 2022 and most of 23. That's still going to kind of depress it in our rankings. We need to see more upside movement from that before we see that climb the ranks.
All right. Appreciate the insight as always, Chuck. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.